And it looks like as we end summer, the last month of summer coming up, the last month and a week, it looks like the bullion banks are starting to position, as I mentioned last week, to go long the precious metals. Long, long, long. What's that going to do to the price? It's going to go uppy, uppy, uppy. All of the things considered, unless you have the financial houses going record short, I don't expect that that's going to happen. I think. Hey everybody, this is Rob Kientz with GoldSilverPros.com. I'm coming to you on Monday, August 14th, 2023, and this is your weekly market wrap-up. We're going to talk first about what's going on with the economy. The data that we saw last week through the Friday the 11th was somewhat mixed. We had an increase in the amount of consumer credit used. People are putting more money on their credit cards. That increased from 9.5 billion last month to 17.8 billion. Nowhere near the 40-some billion that we saw in some prints earlier this year, but still an increasing amount of credit being added to consumer credit cards and shows no signs of slowing down. It means consumers don't have money to pay for the basics. Overall, U.S. trade balance fell to a negative 65.5 billion, indicating that there is some deflation in demand because U.S. is sending less money overseas to buy products and services. And we'll show you here in a moment where it looks like as a result, the Chinese economy is deflating. We'll get into that here in a moment. Looks like we're headed into a deflationary cycle around the world's economies. U.S. wholesale inventories fell by 0.5%. Overall, on the job front, initial jobless claims spiked to 248,000. And that seems to coincide with the less than rosy numbers that we saw in job creation earlier this month with the non-farm payrolls. And when we look at revised number from non-farm payrolls, it's quite possible in the last month the U.S. job market actually receded by 30,000. We'll look for the revisions to come as they always do. Consumer prices went up 0.2%, which was in line with expectations last month. Not any sort of surprise. The producer price index, the part of the supply chain right before consumers buy products, because producers have to produce them, did rise 0.2%. So we're seeing a little bit of inflation, not much. We're seeing actually more deflation in terms of demand, while we've still had modest inflation in prices. Looking at the economy, we're looking at the Treasury market. Everything shorter than 2-year and U.S. Treasury bonds is over 5%, led by the 6-month, which is 5.495%. The U.S. 2-year benchmark is rising. It's almost at 5%, 4.937. It's up 0.044 on the day. And we're still in that yield curve inversion I've been talking about here for just about forever. Cryptocurrency basically is going sideways. Bitcoin is trading at 29,334. So far today, that's down $85. If we look at Ethereum, it's at 1844.13. That's down $12.35. Litecoin is at 81.91, down $1.41. The rest of the market seems a bit tepid. The Dow Jones is up about 21 points to 35,372. Not a big move on a Monday. S&P future up $1.50. NASDAQ future up 975. Nothing to write home from there. We're going to get into the stories of the week. Here we have a story from Charlie Zhu and Helen Sun from Bloomberg Markets. China's crashing loans show risk of Beijing acting too late. It says here from the article, 3 things we learned last week. Number 1, China's economy weakened further in July, but Beijing was slow to arrest the decline. The nation's banks extended the smallest amount of monthly loans since 2009, and aggregate financing was less than half the level forecast by economists. Worse, loans to the real economy plummeted to renminbi 36.4 billion, the lowest since 2006. According to the article, as Goldman notes, last week's print underscores the weak demand in the economy and the need for the government to implement more easing measures. In addition, both consumer and producer prices fell in July from a year ago, the first time since 2020 that both sets of prices registered a decline. This is taking place as companies are slashing prices to jumpstart competition, underscoring deflationary pressure that's building in China. Hence, why the U.S. is sending less money over there, and we see our current accounts deficit shrinking. Over on the trade outlook, according to Bloomberg, the trade outlook is looking similarly dire. Overseas shipments dropped in July by the most in more than 3 years, and imports contracted for a fifth consecutive month. While it's not surprising to see the former shrinking due to slowing global growth, sustained weakness in the latter is worrying as it suggests that domestic demand is also faltering. Ladies and gentlemen, China can't buy their own production. According to Lu Ting, chief economist at Nomura Holdings Incorporated, the credit demand is very subdued. The key remains to send clear policy signals regarding the private sector, foreign companies, and the real estate industry so that people become more willing to borrow and invest, including in housing. Meanwhile, Country Garden holding companies' troubles reflect the impact of a delay in rolling out forceful housing market policies. Once a country's top builder, the developer has become a penny stock, as it was said to be considering a move to extend some of its notes that will fall due soon. This is adding to overall gloom surrounding Chinese assets. The biggest builder is now a penny stock in China. Number 2, elsewhere, anti-corruption campaign aimed at pharmaceutical industry is evoking memories of previous government crackdowns. Local media reported that as of July 26, a number of hospital executives being probed for allegedly violating laws and regulations was double the tally registered from last year. Number 3, given that things are looking so glum, according to Bloomberg, authorities are taking incremental steps to bolster economic growth and contain the risks. The finance ministry said to be looking to allow provincial level governments to raise about 1 trillion yuan, which is the equivalent of 138 billion US dollars, via bond sales to repay the debt of local government financing vehicles and offer off balance sheet issuers. So they can issue one debt to pay another. Okay. And another bit of good news, the nation has also lifted a ban of group tours to a slew of countries, including US, UK, Australia, and a rebound domestic and global tourism. I don't think that that's going to solve the issue, but it's a nice little move. Well, we've got some reports over here in the US. Even though we have a deflating economy in terms of production, rents are surging and back to record highs. Last week's CPI report was surprisingly dovish because, as the article notes, we have discussed extensively in the past years, rent inflation, which is the biggest variable in CPI's biggest category, shelter, has turned. It is now decelerating sharply. Recall that was 2 years ago, CPI's report subdued and badly lagging prints. That means that the average across the nation, apartments today are renting for less than they did 1 year ago. This marks a major deceleration from previous years. Unfortunately, there's one big snag with the analysis. It looks like the annual rate of change, not the actual current read of the index, meaning they were talking about a rate of change, not the index itself. The annual rate of change, a favorite indicator of economists, indeed turned negative in July. However, overall, the apartment list rent index continues to surge. In other words, the data is not the indicator they're using for the data is not actually falling the rent. Apartments list rent index may be lagging the price data by a little while, but in other words, the asking rent hit just short of a record high in July, according to Redfin. So we've got some conflicting data, but it looks like the backward-looking indicators of rent data are showing a deceleration over a year. But if you look at the data as of right now, rents are surging very quickly. Prices are getting higher. We'll turn to the shared part of the presentation as we go over the gold and silver markets for you, ladies and gentlemen. We're looking here at CME Gold. And as we look at that market, everybody's trading December. As you can see, 650 contracts came in. We had overall volume on Friday of 122,320 contracts. The exchange for physicals owed to London market, something that Andrew McGuire and I talked about last week as he came on the program Thursday, was 1602 for Friday. For Thursday, it was 3162, and for Wednesday, it was 5,050. The exchange for physical mechanism, where you take a COMEX contract and trade it or move over to the London OTC unallocated market, was spiking last week, particularly on Wednesday, both for gold and silver. We'll show you silver here in a moment. Looking at the settlement data, we see on Friday that you had the 122,320 contracts, fading the price at $2.30. If we go to Thursday, it faded the price about $1.80 on the December contract. And on Wednesday, it faded it by $9.30, and Tuesday by $10. A general slow decline in the paper market, not the physical market per se for gold. Looking over at silver, a similar dynamic is happening, although we do have a robust trade for September, unlike gold, which most of the trades moved to December. September and December are both active months, and September had slightly more volume at close at 67,645 than December at 66,291. Although we see contracts falling off of September moving to December. So by the next time I do this, December will be the dominant contract month for silver as well. Looking at Friday's data, we didn't have any deliveries. We had 600 exchange for physicals over to the UK market. No deliveries on Thursday's data, 670 exchange for physicals. On Wednesday, it spiked exchange for physicals to London 44.75. 4 deliveries in the local market here in the US because August is not a big trading month, and then more exchange for physicals. So a lot of moving over to the UK market, both for gold and silver. I found something interesting, the CFTC commitment of traders report. I'm going to spend a minute talking about that. That's as of August 8, 2023. This is the latest report. Yes, it does lag. It's about 10 days behind when it's produced by the CFTC. So it gives us a look into what happened in the past. For silver, the astounding number here is that the swap dealers dropped 12,452 contracts while adding 383 long, meaning net, they increased their long position to about 12,800 contracts. The other side of that trade was the managed money dropped 12,593 longs. So the bullion banks convinced the managed money to go net short or reduce their long position in the markets. And look at now what we have. We now have a net long position for the bullion banks in silver. That's right, a net long position on the derivative markets and the bullion banks for silver. We've seen this before, and silver price moved up on the news. Right now, the swap dealers, or as of this report, as of August 8th, are at 35,632 contracts long silver and short 35,133. The managed money has gone net short 35,766 to 31,985 long. Essentially, this points out that the bullion banks are almost always trading opposite of the financial houses. And guess who the smart money is? It's the bullion banks. I think they're expecting the silver price to rise in the fall, as I have been predicting all summer long. Now, I realize we've had a recent price fade, but don't worry. I think that had a lot to do with short covering. Again, that had a lot to do with short covering by the bullion banks. I do expect the prices to move back up because of the short covering and them moving more long. All right, moving over to gold, we have, oh my goodness, we have a very similar dynamic. The swap dealers dropped 15,697 of their short contracts, meaning they net are more long than they were the week prior. And guess who took the opposite side of that trade? Mostly the managed money, as they added 12,000 shorts. Took the other side of that trade. So in both gold and silver, the bullion banks are dropping shorts and moving longer, or having another way to look at it is a higher percentage of their overall position is what? Long. What does that say that the big bullion banks are going or seeing in the price of gold and silver moving as we get closer to the fall? Now we have another month before we officially hit fall. Us here in Texas who have been suffering triple-digit heat for most of the last 2 weeks to extend at least another week and probably through the end of August, if we believe the local weather reports, would love for fall to come so we can get some cooler weather. And it looks like as we end summer, the last month of summer coming out, the last month and a week, it looks like the bullion banks are starting to position, as I mentioned last week, to go long the precious metals. Long. What's that going to do to the price? It's going to go uppy. All of the things considered, unless you have the financial houses going record short, I don't expect that that's going to happen. I think that they were either taking profits or cutting their losses by selling their long positions. The bullion banks had them positioned over a barrel with a recent price fade. And so they took the opposite side position to be in the money. That's why we call them the sharps. I anticipate this means the dumping of the bullion banks, paper and gold and silver shorts means we're going to have much higher prices in the fall. And I think that coincides with the economic data. We're having deflation. Now, gold does do very well in deflation and inflation. And I think this is a temporary deflation because I think at some point we're going to have massive inflation come back to the economy. We're in stage 1 of this 3-stage move into a potential hyperinflationary episode with the US dollar. given the fact that the world is dumping the US dollar. We certainly hope that that doesn't happen, but it's a possibility. But it looks like some of the big players in the market are moving longer in the precious metals. Of course, we've had pretty robust industrial size demand for those precious metals, indicated by the EOP, the delivery numbers, and the amount of metal flowing out of the COMEX in terms of registered stocks. So I think that means that industrial and big investment demand is there. The retail market is a bit weak. We've seen sell-offs in the ETFs, SLV, and GLD. I think that those will reverse as we get into the fall and we look deeper at the economic data. I think we're closer to a recession if you look at the net effect of all the economic data we've been seeing in 2023. Overall, it has not been positive for the economy. Even though the stock markets are doing okay, the stock markets don't reflect the underlying aspects of what's going on in the economy. For example, corporate failures have surged. Bank failures have surged. We're starting to see a lot of non-profitable enterprises go under. And I think that's an indication of how much rot there is in the economy and how much excessive capital there was on bad ventures that are now turning the economy down. Stay tuned to this channel as we continue to bring you the best of what's going on in the market with our weekly market wrap-ups. Once again, this is Rob Kientz, Gold Silver Pros. This is our report for August 14th, 2023.